What's going on, you guys? Chandler come back at you from Easy Stock, and today going to be going over one of the most seemingly confusing concepts in all of trading, which is option trading. So we're going to be going over calls and puts today, how they work, and let's get right into it. Alright guys, so hopping right into it. The first things first is you want to find out what stock you think is going to go up or which one is going to go down. So for example, we're going to go with Microsoft here. So there's two options. If you're on Robinhood here, you can go ahead and hit buy or trade and then hit the trade options. And you're going to get a list of these things at the top, and it's basically in short, call options mean you think the stock is going to go up, and a put option is when you think it's going to go down. So if you have an idea, hey, the stock I know is going to go up in the next 2 weeks or so, you have this bar up here at the top, and it'll let you go ahead and pick when you want the call or the put to expire, your option to expire. So now you're going to see all these nice and fancy numbers up here. So right now we have June 26th selected, and it's currently June 15th. And you can see right now the stock is currently trading at $188.25. Is this going to continuously update as we continue to go throughout this? So now looking at the screen here, you're going to see a bunch of numbers, and these are all these calls. And right now I'm selected on buy and call. So buying calls here, again, we think the stock's going to go up. So again, right now the price is $188. So if I think that the price is going to go up to $195, I would go ahead and purchase this call for $2.02, the one right in the middle of the screen there. So the $2.01 though is that premium that you're going to pay to buy 100 shares of this stock. So basically a call or a put, you're buying 100 shares for a really, really good deal. But if you don't get up to that certain call price, that $195 that we're talking about right now, you lose whatever the premium is. Now that premium is the $2 right now that it's at right now. That's going to be a kind of like a fee that you pay to hold the 100 shares. And that number is going to get charged by 100 because you have 100 shares. So if you went to one share here, or one contract is 100 shares, your max cost is going to be $201. So again, that's times by 100. So now if you look at the break-even point, even though you're saying that the stock's going to go up to $195, you have to factor in the premium that you're paying. So that $2.01 per share, that means that share has to actually go up to $197.01 for you to break even. Now next to it, you can see it needs to go up about 4.5% to be able to get there. But you always just want to add those two together, and that's going to get you your break-even point. Because if you get anywhere between $195 and $197, you're going to be losing money, but you're not going to lose it all. Because if that stock ends at $194.99, you're losing all of your money, so all your premium. So if you have one share and you bought it, you'd lose $202 for that 100 shares because you wouldn't want to purchase the stock at $195 if it's not as valuable. So you would just let it expire. But if it goes up to $196, well, then you're just losing a little bit of your premium that you got in there. You're still going to exercise because you're not going to lose as much money there. And then if it goes over that $197, you're going to see a huge increase in your return. If it goes up probably about $2, there's lots of different websites you can go out there. Option call calculator, or option put calculator, any of that stuff. Those websites will help you see what you can get for your profit. And you only really need to go up about 5-6% for this specific option, maybe up to like $198, $199 to be able to like double your money, which is kind of crazy if you think about it. Now the opposite is true when you go to puts. Again, you can see the share price $188.47. You're thinking the opposite. You think the stock's going to go down within these 2 weeks that were selected, June 26th. So right now, if you bought a $190 put, your break-even point's going to be $184. That's factoring in the $5.45 per share premium that you're purchasing there. And again, if we scroll down here to that 185, this is more of like a closer number, so we're going to go ahead and use that one. So 185, and then you subtract $3.25, which is that, you're going to get 181.75. So you need this to go down about 3.5% to be able to break even there. Obviously, the more it goes down, the more you're going to win. And one last thing to go over here. Obviously, the more extreme you want the stock to go up, the cheaper and cheaper the premium's going to get. It's because it's less and less likely to get up to that. And the opposite is true. The farther and further go down, the more and more expensive. So this one basically only have to go up by 0.5%, but it's going to cost you $1,465 per contract. So it's really not worth that much. So in recap, calls and puts are a great way to make a lot of money with not really putting too much down or too much at risk. but they are a lot more risky. You can't just wait them out because you do have that deadline set. And you are able to sell it at any single time you want. So if you have one set for June 26th, Microsoft shoots up to $300 tomorrow. You can sell it right there and cash out big. You don't have to wait for it to expire, but you have until that time to sell it, and you just got to make it past the call price plus the premium to break even, and anything over that is a lot of profit waiting to happen. Hopefully this helped you out a little bit. If it did, make sure to hit that like button. Let me know what you guys want to see in the next episode. Have a great week. See you later. Peace.